Most Americans between 55 and 64 still have not realized that the new $6,000 senior deduction can lower their federal taxes in a real way. At the same time, the new $40,000 SALT cap is quietly sending bigger refunds to higher income households in high tax states. That means one part of America is hearing tax relief, while another part still feels like the middle class is paying for everything. And here is the trap. Even if you qualify for the new senior deduction, one wrong filing choice can erase most of the benefit. Meanwhile, wealthier itemizers in places like California, New York, and New Jersey are using the new SALT math to pull back much bigger refunds. That is why this is not just a tax story, it is a strategy story about who understands the rules first. In this video, I am going to show you the real winners, the hidden traps, and the filing choices that matter most in 2026. We will cover the senior deduction, the standard deduction, the SALT cap, the SALT cap, the new charitable giving rules, Trump accounts, and refund delivery friction. By the end, you will know exactly what to watch, what to claim, and what mistake can quietly cost you thousands. Let's start with the part most people have heard about but still do not fully understand. If you are 65 or older, the IRS says you may claim an additional $6,000 deduction, and if both spouses qualify, that can become $12,000 on a joint return. This deduction is temporary, running from tax years 2025 through 2028, and it is available whether you take the standard deduction or itemize. That matters because this is not a niche benefit for one filing style. It is a broad planning tool if you understand where it fits. The phase-out is where many people will get blindsided because the enhanced senior deduction begins to phase out above $75,000 single and $150,000 joint. So the benefit is real, but it is not universal. And that makes planning more important than celebration. Now layer that on top of the regular standard deduction because that is where the real filing decision begins. For tax year 2026, the standard deduction is $16,100 for single filers, $32,200 for married couples filing jointly, and $24,150 for heads of household. Those are your baseline numbers before you even begin thinking about age-based add-ons, the enhanced senior deduction, or itemizing. So the first real question is not, do I get a bonus, but which deduction path actually wins on my return? If your deductions do not beat the standard amount, itemizing is not a strategy. It is just extra paperwork that creates complexity without improving the outcome. If your deductions do beat it, the difference can become meaningful very quickly, which is where the middle-class tension in this law becomes obvious. The biggest headline tax break this season is not really the senior deduction. In raw dollars, the SALT deduction expansion is the larger story. And that larger story is disproportionately helping upper middle and higher income households in high tax states, which is why the emotional reaction feels so uneven. The law raised the SALT cap from $10,000 to $40,000, giving taxpayers with high state income taxes and property taxes a much bigger federal deduction if they itemize. In the Navy, federal California refunds were up 21%, versus an 11% national average, while Florida and Texas were only up about 6% and 5%. Some people are getting relief because they are older, while others are getting much bigger relief because they live in places with heavier state and local taxes and enough deductions to itemize. That distinction matters because it explains why the same law feels generous to one household and underwhelming to another household with less deduction power. Imagine a married couple with $250,000 of income and enough taxes, mortgage interest, and charity to itemize. Under the old $10,000 SALT cap, they were better off taking the standard deduction because their itemized deductions were not strong enough. Under the new $40,000 cap, they can deduct much more, itemize, and lower their federal tax bill by about $3,300. If a senior household is living on $23,000, $30,000, or even $60,000, the SALT expansion may do almost nothing. They may not itemize, and they may not have enough property tax, mortgage interest, or charitable giving to beat the standard deduction anyway. So the emotional result is obvious. One side sees a meaningful windfall, while the other side sees complexity and maybe a modest benefit. The standard deduction and senior deduction can absolutely help, but the largest savings often go to taxpayers with enough deductions to structure their return strategically. Now let's move to the charitable giving trap. Starting in 2026, itemizers generally cannot deduct charitable contributions until those gifts exceed 0.5% of adjusted gross income. So if your AGI is $250,000, the first $1,250 of donations may produce no charitable deduction benefit at all. That is a structural change, not a rounding issue, and it quietly changes the economics of giving for people who donate consistently each year. On top of that, for top bracket taxpayers, the value of the charitable deduction is effectively capped at 35% instead of 37%. That does not mean giving stops making sense. It means the federal tax value of giving is now less generous at the top than it used to be. So a large donor may still give, but the after-tax math becomes less attractive, especially when compared with prior planning assumptions. There is one smaller win here. Beginning in tax year 2026, non-itemizers can deduct up to $1,000 single or $2,000 joint for qualifying cash gifts. But that benefit is narrow because it does not apply to gifts to individuals and does not suddenly transform giving strategy for most households. Other guidance also notes that donor-advised funds, supporting organizations, and private foundations are excluded from this new above-the-line rule. For seniors specifically, qualified charitable distributions still stand out as one of the cleanest tools in the code. If you are age 70 and a half or older, a QCD from your IRA can remain one of the best ways to support charity while reducing the income that appears on your return. That matters not only for tax liability, but also for knock-on effects like Medicare premiums and other income-based thresholds that penalize higher reported income. So while the itemized charitable deduction got more restrictive, the retirement income planning angle still gives seniors a very usable lever. Now let's move to the next major development, Trump accounts, which many people are hearing about without fully understanding the structure. The government is moving ahead with a pilot structure that includes a $1,000 contribution for eligible children, and that sounds simple on the surface, but it is not just free money. It is a planning vehicle with rules, timing, and potential cost drag that families need to evaluate carefully. If a taxpayer has grandchildren, this is where your script becomes personally relevant again because the account can look attractive without necessarily fitting the family plan. Small balances are sensitive to fees, administration, and future implementation details, which means careless enthusiasm can destroy the value of a tiny seed account. So the real message is not rush in blindly. The real message is watch the rules, understand the structure, and decide whether it truly fits your family. Now we get to the part that creates real friction in 2026: refund handling and payment delivery. The IRS has announced a phase-out of paper tax refund checks for individual taxpayers, pushing more refunds toward electronic delivery and online account workflows. That means "I'll just wait for a check" is becoming a weaker strategy, not a safer one, even if it feels more familiar. If the IRS cannot complete a direct deposit, you may receive a CP53E, notice directing you to update or provide bank information through your IRS online account. Build the IRS online account first, check the routing information before filing, and treat digital accuracy as a financial control rather than a tech preference. So here is the practical roadmap. First, determine whether the enhanced senior deduction applies to you and whether your income phase-out weakens or removes it. Second, compare your standard deduction path against itemizing under the new SALT cap and the new charitable rules before assuming itemizing is worth the effort. Third, if you expect a refund, make sure your direct deposit information and IRS online account are ready before filing. Fourth, if you are near Medicare thresholds, do not make Roth conversions or large sales without checking the income impact first. The truth is simple. The new $6,000 senior deduction is real. The $40,000 SALT cap is real, the charitable deduction trap is real, and the refund delivery friction is real. And the people who win in 2026 will be the ones who understand those four things before they file. Comment below with your questions or which change surprises you most. Like this video and subscribe to Tax Borders to stay ahead of the game.